Remember the E-Trade baby back from those commercials in the 2000s? That well-spoken baby would charge people $10 per trade within their brokerage accounts. Now, every broker-dealer has seemingly gone to the no-fee trading model. Does this mean that all of these companies are now non-profits? Probably not, but it can be difficult to decipher where companies are actually charging you in this new age model. So let's go over the top 3 ways that the financial industry quietly reduces your returns in a way that they don't quite call fees, but act very similarly. First one is payment for order flow. If I read the Google AI response, it would tell me that payment for order flow is a legal yet controversial practice where retail brokers receive rebates from market makers for routing customer orders to them. I don't really know what that means, but I made this fun graphic to help explain what payment for order flow is. Let's take a look. So first, in the top left, we have you. You go to whatever broker dealer you're using. I've labeled a couple here. I've changed their names, not because it really matters, but because I think it's funny. So we have Charles Schwab, we have D-Grade, and we have Robinhood. You go to one of your broker dealers and you say, I'd like to buy 50 shares of that stock that you list at $100. Please. So then you pay them $100 because on their website, when you logged in, it said, for $100, you can get 50 shares. They go, yeah, all right. And then they turn around and they go to their market makers. See, in the past, in our previous example, when you dealt with the baby would simply fulfill that trade and charge you a fee on top of that $100, and maybe you'd pay $110. But remember, we're in the new era of no trading fees. There are no fees, don't you understand? So that broker dealer turns around and then goes to the market maker. This is someone that they can have execute the trades for them. So they go to someone like Citadel Security, Sasquatch, USB. These are all fake names again, because I think it's funny, not because it matters. And they say, let me get 50 shares from you. And they forward that $100 along. Those market makers then go to the New York Stock Exchange, or whatever exchange that they're using, and they say, what's the cheapest that you can sell me these shares? The New York Stock Exchange, which I have played by Rick Harrison here from Pawn Stars, then goes, the best I can do for 50 shares is $98. There's something that I don't need to get into called the bid-ask spread, meaning a price that people are willing to sell a stock for and a price people are willing to buy it for. In this case, someone is willing to sell 50 shares for $98. So USB or Sasquatch or Citadel Security goes, deal, $98, and then they turn back around and go to whoever broker dealer you're using and say, here's your 50 shares. Also, since I'm so grateful that you let me make this trade, I'm going to pay you $1 just for the pleasure of having done that trade for you. So they deliver the 50 shares back to the broker dealer. They pay their $1. Thank you so much. And the broker dealer goes, here's your 50 shares for that original $100. And you go, wow, for free? You just got 50 shares for $100 for free. And it appears free because when you logged into Charles Schwab or D-Grade or Robinhood, on their website it listed it as $100. But really the security was listed at $98. So back in the day, they used to charge a fee and you would see it and then you'd buy it at the market price. Now they simply get paid by the market maker what you could call a fee and then just don't tell you about it. So in your mind, is this a fee? Is it not a fee? Technically, they don't even have to tell you about it because they're not charging you a fee. They're getting paid by someone else for the pleasure of market making. So again, this is one of the ways that they will reduce your returns or charge fees. And I don't really mean to antagonize them. I don't have any problems with these companies making money. They have to for the service they provide. But I'm not a big fan of the lack of transparency. However, it's what the consumers have gravitated towards. So that's what it is. The second way that broker dealers reduce your returns while keeping some of that reduction, which again is not a fee. There are no fees in trading anymore. Is keeping excess cash in the portfolios and keeping a portion of the interest that that cash earns. This is very similar to how your bank makes money. Again, your bank is also not a nonprofit. When you go and open up a checking account or a savings account, you earn sometimes a little bit of interest, sometimes maybe 0.01, 0.02% interest. On checking accounts, you generally earn nothing. The banks will then go and invest or lend out that money and earn some kind of return or interest on that money. Sometimes they'll share some of that with you. Again, if you have a savings account, especially a high yield savings, you'll get a few percentage points, but they're often earning a percentage higher than that and keeping the difference. The broker dealers have caught on to this business model and have instituted that big time. I'm picking on Schwab a little bit here because over half, in some estimates, some have them just under half, but roughly half of Schwab's revenue comes from this. The majority of their revenue comes from cash interest spreads. I have a good example of one way that they do this. So Schwab has one of the very few robo-advisor platforms where they will invest for you, and they do it with no fee. They're one of the only ones I know that don't charge a fee for their robo-advisor, which again is just a portfolio that's invested and managed for you. This is an example of their aggressive growth model. When you think aggressive growth, this is likely someone that's very young or has a long time horizon or just a very high risk tolerance and risk capacity. This person probably should be in all stocks. If not all stocks, then maybe all stocks and a little bit of bonds. This person likely doesn't need to keep cash in their portfolio because we know that stocks and bonds grow more than cash in the long term. And if someone's an aggressive investor, they don't really care about the short term as much as they do the long term, most likely, or they're at least willing to take on that risk. If we look at how this portfolio is invested, the aggressive growth, this is the most aggressive one that they have. It's 94% stocks, making sense, and then 6% cash with no fixed income. Again, from a purely investment standpoint, if you were doing this yourself, in this portfolio, as far as I can see, there's not any reason to keep cash over fixed income, even really fixed income or cash at all. It should just be 100% stocks. If not 100% stocks, then maybe 94% stocks and 6% fixed income. The reason they do this, again, is on that 6% cash that's in your portfolio, they're collecting a large portion, if not the majority, of the interest that that cash accumulates. This reduces your returns because, again, there's a portion of your portfolio that's left uninvested. It's not growing really relatively at all. Maybe you're getting a couple percentage points on their cash sweep program, or maybe if it's moved into a money market, you're getting a few more percentage points. But you're certainly not getting the 8, 9, 10% long-term growth that equities get. You're maybe getting 2 or 3% long-term at best. So this is really one of the biggest models that Schwab uses, but there's other companies that do this very same thing. The last category I wanted to go over was expense ratios. And expense ratios are simply the fee that you're charged for being invested in a fund. So I go over this mainly because broker-dealers have also come out with their own proprietary funds. So Charles Schwab has Charles Schwab Index and mutual funds. Same for Vanguard, same for Fidelity, same for BNY Mellon. Most of the large custodians and broker-dealers have their own funds these days. And it's important to consider what those funds are actually charging you. This is the most obvious of the categories, so I won't go into it at length, but it's important to notice. So I have a quick comparison just to wrap us up between the Fidelity Magellan Fund. This is the famous fund that Peter Lynch used to manage back in the late 80s and 90s. And then we have the Vanguard S&P 500 Index Fund. This is a very popular fund that people will often recommend, VOO. So if you take a look at these two funds, you can see the expense ratio for VOO is only 0.03%. That means you're paying 0.03% on whatever amount you have inside the fund at any given time. If you look at the Fidelity Magellan Fund, that expense ratio is 0.56%, so over half of a percent. Plain and simple, in the Magellan Fund, you are paying more in fees. This one is really not, I wouldn't say quiet, but I think it's easily overlooked. It's not hidden, is maybe a better way to phrase it, but it is often overlooked and people don't notice it all the time. In order for the Magellan Fund to outperform the Vanguard S&P 500 fund, it would have to do 0.53% better per year because that's the extra amount of fees that's being charged. And maybe we'll make another video about this, but we've only observed anywhere from 9 to 18% of active managers actually outperforming the market over any given time. So it's actually very rare for an active manager to outperform the market. And so when you throw a higher fee on top of that, we start to get very skeptical. Another good example that we can throw in to relate to our last point is that turnover ratio. Turnover ratio being the percentage that funds are turned over in the portfolio. How often is the active manager trading the portfolio? How often is the manager trading the portfolio? And we can see VOO is a passive fund. It's an index, so it just tracks the S&P 500. And there's a very, very low turnover ratio, only 2%. In the Magellan Fund, the turnover ratio is 49%, which means that they're trading much more actively, much more frequently in that fund. And so when we think back to when we talked about payment for order flow, if we're incurring costs every time there's a trade, and it's a little bit different inside of funds, but there's still a cost of doing business of whenever you're trading, that's another thing that can potentially reduce returns long term. And while this is sort of cherry picking, it is worth noting that VOO, or the Vanguard S&P 500 fund, has outperformed the Magellan Fund over the last 15 years, and we can see that in the top right. So that's my list of the top 3 ways that the financial industry quietly lowers your returns. Of course, this is not a comprehensive list. There are other things that can lower your returns in the long term, but I thought this was the main ways that the large broker-dealers do it and the main things that would actually impact you. If you have questions, please feel free to leave those in the comments. And if you have suggestions for future videos or topics that you'd like to see me cover, please also leave those down below. Thank you.